Just walk us through the share swap as it stands right now. What do we know? What is going on the side of NIC and vice versa on the side of Commercial Bank of Africa?
Yes, as you mentioned earlier, the merger will create the largest bank by assets with a market share of over 9%. In our view, we believe the merger will create a larger and stronger bank, which is positive for Kenya's financial stability. Despite consolidation recently in Kenya, the banking system remains relatively overbanked with a large number of small banks at the moment. There are about 40 banks in Kenya compared to Nigeria and South Africa, where we have a smaller number of banks, despite the larger economy. So we feel that this will create a larger and stronger bank for going forward. As based on the investor briefing by the two banks, and as you mentioned, this is they announced that they have agreed on a share swap. The share swap arrangement, but there are some conditions that need to be met before the finalization of the merger. First of all, there is a need for shareholder approval, which the two banks expect by the first quarter of 2019. There is a need for regulatory approval, which the banks expect in the second quarter of 2019. And there are other various transactional agreements that will mark the completion of the merger, and that is expected by the two banks in the third quarter of 2019.
Christos, just before 2016, where we saw that historical legislation that capped interest rates at so-called prime lending 4 percentage points above the central bank rate, or you could call it the repo rate. Just before that, Kenya had private sector extension above 20% on average. As we speak right now, it's close to what, 4.15%. Do you get the sense that this kind of move, the mergers and maybe acquisitions in the market away from what you had just mentioned, over 40 banks in the market, which seems to be quite a lot, do you get the sense that this kind of merger is the right prescription to actually address the very meager private sector credit extension?
Yeah, it's a very challenging operating environment in Kenya at the moment, particularly for the smaller banks in the system. Smaller banks tend to have a weaker deposit franchise, a relatively high reliance on more costly sources of funding. And obviously, you mentioned the lending rate caps that has lowered the lending margins and squeezed profitability, which has primarily affected some of the smaller banks in the system. At the same time, tighter supervision, increasing regulatory requirements for banks globally, has made it more expensive for small banks to continue operating. So it's something that we have seen, as you mentioned, both in Kenya but also in sub-Saharan Africa, and something that we do expect to continue going forward, mergers and acquisition and consolidation in this system. In addition to other sub-Saharan African systems, given the challenges that some of the smaller banks are facing at the moment. In contrast, I mean, this will allow the merged entity to have a stronger franchise. It will leverage the strengths of the two banks that they had before individually. Their increased scale will also allow them to attract larger corporate clients, while higher efficiencies of scale will support the profitability, but also their ability to invest in the strategic growth and digital expansion going forward.
Christos, let's talk about the two banks and what both parties actually bring to the table. If we're to look at NIC more on the investment side, Commercial Bank for Africa is more on the retail side. Do you get the sense that this is about to maybe put or apply more pressure on the likes of KCB, Kenya Commercial Bank, and Equity Bank, which for the longest time have dominated everything in much of East Africa?
Yeah, I mean, this opportunity for the merged entity to leverage on the strengths of the two banks individually. As you mentioned, CBA has a strong retail client base, but also it's very successful in terms of mobile banking. It has the most successful mobile banking platform in Shwari. While NIC, as you said, is a leader in asset finance, but also has a large mid-sized corporate customer base. So, a stronger franchise going forward, third largest bank in terms of assets, second largest in terms of deposits, will bring some more competition in the market. At the moment, we have KCB, the largest equity bank, the second largest. Well, Coop Bank now will become the fourth largest because the merged entity will potentially be larger than Coop Bank. So now we will have these four banks with around 10 to 13% market share. So it will definitely enhance the competition in the Kenyan market.
Christos, finally, before I let you go, two questions here. One, you do highlight integration risk. This is quite interesting, and I just wanted to touch on this. What integration risk is Moody's looking out for when it comes to this particular merger? The other issue is it's very clear that the capping of interest rates 4 percentage points above the repo rate was just the presidential campaign to just get the polls. Do you get the sense that moving forward, this is the right prescription for the smaller banks to gain market share, given the fact that the interest rates are actually capped 4 percentage points above the repo?
On your first question, the integration risk that we see is the bank's ability, first of all, to retain its pre-existing customers, ensure that its pre-existing business does not suffer by maintaining adequate management focus, staff morale, enough resources in running the two banks individually. Also, obviously, because there may be a need to eliminate some positions, so they need to effectively communicate to staff the benefits of the merger, be open and address staff concerns in order to avoid turnover of the high-quality staff. There is a need to integrate the financial operational systems, the infrastructure of the two banks, which obviously needs to be done smoothly with minimal disruption to both staff and customers. And obviously, finally, there is a need to train staff to ensure that there's a common culture, purpose, but also adequate knowledge of the new technology systems and infrastructure that would be implemented in the merged entity. So all of these we consider to be integration risks for the bank going forward. With regards to your latter question, obviously the interest rate cap decision is a political one, so I won't comment on that. But regarding the impact, actually, we've seen some of the smaller banks being more impacted than some of the larger banks because the smaller banks tended to have a high cost of funding, and because their margins have been squeezed now and on the lending side as well, their profitability has been more affected. Some of the smaller banks also operating in higher risk niches in the